Welcome back to the deep dive. We need to talk about the last 24 hours.
There's no way around it.
No. You've seen the alerts, you've seen the red candles, and if you follow the daily briefings, you know the numbers are just ugly. But today isn't about staring at the price chart and panicking.
No, panic is useless. We need to understand the mechanics of what just happened.
Exactly. Because the intelligence briefings we're looking at today, specifically covering February 5th and 6th, they're using terms I haven't seen in a while.
Liquidity vortex.
Systemic capitulation. It feels like the floor we've been standing on since late 2025 just evaporated.
That is the right visual.
Yeah.
Evaporated. And to be specific, we're talking about the breach of the $60,000 structural support level.
Right.
That wasn't just a number, that was the thesis. The entire market was operating under the assumption that institutional demand had created this concrete floor that simply could not be broken.
The institutions will save us narrative.
Precisely. And that narrative died yesterday. So our mission today is forensic. We need to figure out why the floor collapsed, and more importantly, where the smart money is moving now that the floor is gone.
And we have a lot to get through.
Yeah.
We need to look at that smart money. Specifically, what Tether's doing is fascinating because it's so defensive.
Okay.
We need to talk about the miners, who seem to be having a full-blown identity crisis.
And we absolutely cannot ignore the macro vice tightening around this. We have stalled talks in Oman and this new, very serious national security probe involving AI chips and crypto.
Okay. But let's start with the market structure. I want to frame this as a what we knew versus what's new. Because earlier this week, literally just February 3rd, the vibe was totally different.
Oh, complete.
We were talking about $75,000 as the baseline. We had the Trump trade premium. The assumption was that ETF inflows would passively absorb any selling. What actually broke?
Volume. But not in the way you usually see it. You have to look at the BlackRock iShares Bitcoin Trust IBIT.
The big one, the market leader.
The behemoth. Yesterday, IBIT shattered its volume records. Over $10 billion traded in a single session. Now, normally, if I told you IBIT just did $10 billion in volume, what would you assume?
I would assume it's a massive rally. I mean, big volume usually means big interest, big buying pressure. That's investing 101.
Exactly. In a healthy bull market, volume confirms price. But here, we saw the inverse. We saw record-shattering volume coupled with a massive price crash.
Okay.
And when you dig into the net flow data, it gets uglier. IBIT saw $175 million in net outflows. The sector as a whole lost over $434 million.
Okay, so let me get this straight. Billions of dollars of shares changed hands, but the net result was money leaving the building.
Correct. It's what the analysts call a churn or a liquidation event. Think of it as a changing of the guard, but in the wrong direction. You have the strategic allocators, the pension funds, the macro hedge funds who hold for years. They were hitting the sell button.
And who's on the other side buying? Because someone has to buy for a trade to happen.
High-frequency arbitrage bots and short-term speculators. The BlackRock shield, that comforting idea that BlackRock's clients are diamond-handed holders who never sell, that shield fractured. They sold. They looked at the macro environment and decided to de-risk.
That is a significant shift in psychology. It invalidates that whole idea that ETFs are purely a one-way street. But there was one weird anomaly in the data that caught my eye. It looked like the U.S. was panic selling, but not everyone was.
The Australian divergence.
Yeah, explain that.
Yeah.
The U.S. ETFs are bleeding out, and the Australian ETFs did nothing.
Zero outflows, specifically the EBTC fund. It's a fascinating data point because it tells us the geography of the fear. This is a Western-led, U.S.-centric capitulation.
So panic is here.
It's being manufactured in New York and Chicago time zones, the Asia-Pacific region. They're looking at this price action and holding firm.
Or maybe they just view it as a currency hedge in a way U.S. investors don't.
That's very likely. But regardless of the reason, the institutional floor was made in the USA, and it was broken in the USA. That $60,000 breach wiped out the entire Trump premium we saw building. We are effectively back to square one.
So the financial layer's cracking, but I want to go down to the engine room, the miners. Because for years, the logic was simple. Miners secure the network, they earn Bitcoin, they hold Bitcoin.
The ultimate bulls.
Right. We have skin in the game.
That was the pure play era, and I think that era ended yesterday.
That's a bold statement. What exactly happened to end an era?
The economics inverted. You have to understand hash price. It's a metric that tracks how much revenue a miner earns for a specific unit of computing power per day.
Okay.
Yesterday, it hit an all-time low of 3 cents, $0.03.
3 cents. That sounds low, but give me the context. What does it cost them to actually mine a coin?
The estimated production cost for one single Bitcoin, factoring in electricity, hardware, all of it, is currently around $87,000.
Wait, let me do the math here. It cost them $87,000 to make the product. And the market price is hovering between $60,000 and $66,000.
Exactly. For every block they mine, they are effectively lighting over $20,000 on fire. It's mathematically impossible to sustain that business model unless you have free electricity, which, nobody has.
So they're bleeding cash with every hash. This has to explain the news from Bitfarms. Or I guess they aren't called that anymore.
No, and this is the tell. This is the signal that matters. Bitfarms announced they are redomiciling to the U.S. and rebranding as Keel Infrastructure.
Keel Infrastructure.
Right.
It sounds like they build bridges or lay power lines.
Yeah.
It definitely doesn't sound like a crypto company.
That's by design. They are scrubbing the crypto off their resume. They looked at that 3-cent hash price, then they looked at the demand for artificial intelligence compute power, and they made a hard pivot.
So they want to be valued as a utility for AI, not a miner of Bitcoin. But hang on. I thought mining rigs, ASICs, were single purpose. You can't just run ChatGPT on a Bitcoin miner, can you?
No, you can't. You're right. An ASIC can only do one thing: guess hashes for Bitcoin. So when these companies say they are pivoting to AI, what they really mean is they are taking their massive power contracts, which are incredibly valuable, and gutting their data centers to install GPUs instead of ASICs.
So they're swapping out the machines. They're effectively just energy arbitrage firms now. We have the juice. We'll sell it to whoever pays the most.
Correct. And right now, AI pays. Bitcoin doesn't. Just look at CleanSpark. They released their Q1 earnings. A $378.7 million net loss.
How do you lose almost $400 million in a quarter? That seems excessive, even for a bad market.
It comes down to accounting rules. Mark-to-market accounting. CleanSpark holds a massive stack of Bitcoin on their balance sheet. When the price drops, they have to write down the value of those assets immediately. It just destroyed their bottom line.
So holding the asset they produce is actually punishing them.
It is toxic for their stock price. So if you're a CEO, why would you keep subjecting yourself to that volatility? You wouldn't. You switch to AI, where the contracts are stable and the checks clear in dollars.
So if I'm hearing you right, the companies that are supposed to be securing the Bitcoin network are actively trying to stop being Bitcoin companies.
They're becoming infrastructure companies. If Bitcoin mining becomes profitable again, sure, they might turn the machines back on. But the dedication to the network, that is gone. It is purely mercenary now.
That is a structural shift I don't think people have fully processed. Okay, so the institutions are selling, the miners are pivoting to AI. But there's one player who seems to be digging in, but in a very specific way. Let's talk about Tether.
This is perhaps the most strategic signal in the entire briefing. We knew Tether as the liquidity provider, the ones holding T-bills, but in the last 24 hours, they've made aggressive moves to build a moat.
You're talking about the Anchorage Digital deal.
Correct. Tether deployed $100 million for an equity stake in Anchorage Digital Bank.
Why does that matter? There are plenty of custodians out there.
Because Anchorage is the only federally chartered crypto bank in the United States. That's the key. Tether has always had this cloud over it regarding banking access and regulation. By buying into Anchorage, they are effectively buying their way into the regulated U.S. banking system.
They're buying legitimacy?
And infrastructure. This supports their new USAT stablecoin. They are preparing for a world where the U.S. government regulates stablecoins heavily, and they want to be on the inside when that happens. But that's not the only move. They also dropped $150 million into gold.com.
Gold, like physical bars.
Tokenized gold, XAUT, but yes, backed by the metal.
I have to pause on that. The largest player in the crypto economy, the central bank of crypto essentially, is using its profits to buy gold. It sounds like they are hedging against the very market they support.
Or they're being realistic. Think about it. If the crypto market enters a prolonged winter, Tether's transaction revenue might dip. By diversifying into hard assets like gold and regulated rails like federal banks, they are ensuring they survive regardless of the price of Bitcoin.
They're building a fortress that can survive a nuclear winter in crypto.
Precisely. They are betting on a future where stablecoins survive and thrive as a payment layer, even if the volatile crypto assets like Bitcoin struggle.
That is a sobering thought. Tether is bunkering down. Now, we have to look outside the market for a minute because usually when the world gets scary, Bitcoin is supposed to be this hedge, buy Bitcoin when the tanks roll.
The war hedge thesis.
Right. But we've had serious kinetic escalation in the Middle East this week. And Bitcoin didn't go up.
It did the opposite. While gold held firm, proving it is still the primary safe haven, Bitcoin traded like a high-risk tech stock. It sold off. It acted as a source of liquidity, not a store of value. When people got scared, they sold Bitcoin to get cash.
And the situation in the Middle East isn't getting better. We have these talks in Muscat, Oman.
Indirect talks between the U.S. and Iran. The reports say they're stalled, or at least very fragile. This is a binary risk hanging over the weekend. If those talks collapse completely, we could see further escalation. And given how Bitcoin just behaved, that is not a bullish signal.
But there is another geopolitical angle here that I found really surprising. It's domestic, but it involves foreign money, the Chipgate probe. This sounds like a spy novel, but explain how this connects to my portfolio.
It connects because it has massive regulatory implications. We have a new congressional investigation launched by Representative Ro Khanna. It's targeting World Liberty Financial.
That's the Trump-linked crypto project.
Correct. The investigation is looking into a $500 million investment from the UAE into that project.
Okay, foreign investment happens. Why is this a crisis?
Because the allegation is that this wasn't just an investment. The investigators suspect it was a quid pro quo to secure export licenses for NVIDIA AI chips, specifically 500,000 H100 chips destined for the UAE.
Wait, walk me through that. How does a crypto project get you AI chips?
Influence. The theory being investigated is the UAE invests in the political figure's crypto project, and in return, the administration potentially approves the export of sensitive technology.
And the fear is diversion.
The fear in Washington is that those chips, once they get to the UAE, might be diverted to China.
So crypto is being framed as the vehicle for basically bypassing national security controls.
Exactly. And that is why this is so dangerous. It elevates crypto from being a financial policy issue to a national security issue.
That is a huge shift.
It is the Death Star of regulatory risks. If stablecoins and crypto projects are seen as vehicles for sovereign bribery or evading export controls on critical tech, then all that friendly legislation we were hoping for, the Clarity Act, the stablecoin bills, it all gets toxic.
It stops being about innovation and starts being about treason, almost.
It toxifies the water. Democrats could block it purely on national security grounds. And in a market that's already dealing with a liquidity fracture, regulatory uncertainty is the last thing you need.
So let's try to pull this all together. It feels like we are in a completely different world than we were just 72 hours ago.
We have moved from a buy the dip regime to a structural reset. That's the only way to describe it.
The pillars are crumbling. The institutional floor, gone. The miners, they're becoming AI companies to survive. The biggest stablecoin issuer, banking on gold and federal charters.
The asset class is undergoing an identity crisis. It's being forced to decide right now. Is it a risk asset that correlates with tech stocks and AI? Or is it a sovereign store of value? And right now, the market is pricing it as a distressed risk asset.
That's the painful reality. The market is shouting, whisk off, and Bitcoin is getting hit the hardest.
And look, for you, the listener, the so what here is about expectations. You cannot rely on the passive bid from ETFs to save the price anymore. That mechanism is broken for the moment. And you cannot rely on the miners will never sell narrative because they are selling to pivot.
It really does feel like a changing of the guard, or maybe a clearing of the deck.
It's a stress test, a severe one. We are finding out who is actually committed to the asset and who is just renting it for the upside.
Before we wrap up, I want to leave you with something to think about. We've talked about everyone pivoting. Miners to AI, tethered to gold, institutions to cash.
Right.
If the miners are busy chasing AI contracts and the liquidity providers are buying gold, who is left to defend the Bitcoin network itself? Who defends the price?
That is the question. When the mercenaries leave, who are the missionaries? And I'll add one tactical thought to that. Watch the $58,000 level. That's the 200-week simple moving average. It's a technical line, but it has huge psychological weight.
Okay.
If that breaks, the narrative shifts from correction to crypto winter.
58,000. That's the line in the sand.
That's the line.
All right. We are going to be watching that level closely over the weekend. This has been a heavy one, but clarity is better than blind optimism. Thanks for listening to The Deep Dive. We'll catch you on the next one.
Stay sharp out there.